Welcome yet again to Outlook 2024. Today it's markets in 2024 with one of Dalal Street's best known, best loved veterans, Manish Chokani, Director, Enam Holdings, but that's a wrong way to introduce a veteran like you, Manish. Okay,
you make me feel so old, but thanks for having me here.
I call myself also a veteran sometimes. Okay, no, actually, when we talk of Outlook 2024, the first thing that comes to the mind is that 2023 was a damn good year, 20% high, and 8th consecutive year of index returns in the positive. Can we be 9th time lucky?
Well, I hope so. If I were a soothsayer, I'd be somewhere else. But see, the macro conditions for India have conspired very, very favorably, as is well known, and the market's reflecting that reality. Surely expectations are running high, and we are priced for pretty much perfect execution and Goldilocks scenario continuing.
Yes.
That risk always remains, but like it's always said that the big balance sheets of India, whether it's corporate sector, banking sector, government, are all in the right direction. So no real reason to say that we should have a big setback.
Okay.
And the big indices are not overvalued.
No.
You may argue something about the mid and the small and especially the SME exchange.
Yes.
But there's nothing yet in the larger caps to suggest that we're anyway approaching a climax in the market.
No, that's fair, but they're not cheap either.
Sure.
I mean, if you look at forward, we may be 19.5, 20.
That's right. It's not a cheap market by any
Yes, so
standards.
that's why it will be more important for you to help our viewers train their eyes.
Right.
So where would you look for value?
See, the first thing is the market corrects due to top-down reasons. It never happens. You buy stocks bottom-up based on valuation comfort, but you lose it from something unexpected happening top-down. And by its nature, an unexpected development is something you're not expecting.
No.
So this market is not priced for unexpected developments, let's put it that way. So what it means is you may want to keep some gunpowder aside to, if and when there is a correction, you may hopefully have 5-10% money available to dip in at that time.
Yes.
And if it continues roaring, you're happy anyway, your 80-90% which is invested is anyway going to do well. So it's more a question of let's not get into the fear of missing out mode. Be happy with absolute returns, temper your expectations down a bit. Having said that, this is a bull market which will last for long, and there will be rotational cycles sector to sector. And in a bull market, it's very bad to be jumping between sectors, because you miss one, you may not get back on the train. So by and large, it's best to stay invested in companies you know well and not worry about someone else has made so much money in the last 3 months, let me go there and chase that. And then you end up missing everything.
But that I get. FOMO is not a good thing.
So just stay with proper asset allocation and with companies that you like, because this market is clearly pricing in a few years ahead now. It's not about immediate returns.
No, but not all over the place. I mean, there are still banking stocks. For instance, HDFC Bank.
Right.
It's not participating in the rally, nor has Kotak, PSU banks.
Sure.
Do you think there is value in
look, it's a consensus now amongst, I think, everyone you speak to in the market that the large caps is where the value is as opposed to the mid and the smaller ones. And one shouldn't generalize, but generally saying that it's correct to say that the larger caps is where really the action now should be. Secondly, the banking sector was leading the market. Then it's taken its pause, and then hopefully the next leg starts. In this leg, the PSU banks are kind of rallying a bit more, because until now, all they've done is tracked earnings growth. The multiples have not really expanded. And like I've said on some other shows, that you literally have a menu. You can buy a Canara Bank on a forward multiple of 5. You could buy a PNB or a BOB on a 6, SBI on 7, and stuff like that.
Yes.
Till you get to even the great HDFC Bank will probably be, in a year from now, more than $10 billion of profit. And it's probably a 17 multiple for a franchise of that quality. It could easily be, the Kotak multiple is 24, for example. So there's a big gap right over there. So banking surely should be the leader of this market. But if you think of how this market's been running, very similar to the 2004 bull market, you've gone into all the infrastructure names, because the cyclicals are back from L&T to the defense and the railway names. In fact, Hindustan Aeronautics is now in quartile 2 of India, which one couldn't think of many years ago. PSU banks, of course, are very much there to catch up, but a lot of these public sector stocks are trading on 30-35 times forward 1 year on FY25, which one wouldn't have imagined. So similar to the 2004 bull market, infrastructure, power, real estate, banking, and some commodities have been participating against the erstwhile favorites of FMCG and IT and others. So that's really the typical cycle in a bull market.
Okay, but would you be wary of the power, for instance? You know, I was just looking at the power stocks, risen between 50 and 400% in 2023. So those would be the red flags?
So look, it's a valuation call end of the day that, you know, if you want to buy risk-free, the risk-free rate in a bank gives you, let's say, 8%, which means you're giving an implied 12.5 PE multiple. Our market is on 20 times, which means it's not risk-free. You're priced in, you know, a couple of years ahead of earnings. You know there is a shortage of power because post the 2008 crisis, nobody invested in putting up power. So there is a golden period for the power sector. We as a country are short on energy. So whether it's the oil stocks, whether it's the, you know, coal and thermal stocks, or it's the solar, and I'm very hopeful that we start developing nuclear and other renewables very, very quickly, that there is a, you know, whole gamut of opportunity there, and a lot of the private sector players are of scale and size now. So
but I worry about the price.
Pricing, look, I've said it at the beginning that most of the stocks are now pricing the vision of the investor rather than the entrepreneur. Like, you know, Mark Faber used to very famously say at the beginning of the cycle, the entrepreneur has the vision and the investor has the money. And by the end of the cycle, the entrepreneur has the money and the investors have the vision. So we are in that phase where when people are buying stocks on 60, 70, 80, 100 multiples, it's clearly going to be maybe a decade for them to get to that 12.5 PE from which they start making the return of equity of the underlying business. And you've seen this historically, right? In the 90s, we said you have to buy Hindustan Lever on every Diwali, and then it didn't perform for 10 years. Then when the tech boom came,
it went to double digit one day.
Infosys peaked, and then it didn't. The stock didn't perform for 10 years, even though the business did well. The great Reliance, DLF, Bharti, they didn't perform for 10 years.
So let me come to this question.
So it's possible that.
When do you exit? What advice do you have?
So the cyclicals typically, when you know there's an end of a cycle coming and this valuation euphoria is going to an extreme, you will tend to see signs of market tops where there will be IPOs or projects which are not for near term but also visionary, or there are crazy acquisitions being made, or there is a big retail type euphoria or an IPO which comes which is very large and it fails. Having said the fact that we are not a cheap market, we are not so crazy as yet. There are those what I call mini bubbles in segments of the market, but it's not yet large enough to take the entire top of the market down.
Okay, save us those blushes. But I want to ask you a little more about the red flags that we should be wary of. Those questions after a break.